Markets and other experts believed rates were going to be lowered today by the Federal Reserve. Our Washington, D.C. correspondent Rachel Knapp has the details on why that didn't happen.
The FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings.
It was a surprising announcement from Federal Reserve Chair Jerome Powell, announcing they're keeping interest rates the same despite seeing positive readings in inflation and the job market.
We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures.
The Federal Reserve sets these interest rates to determine how much people and businesses can borrow, which could impact getting a new car, your home mortgage, loans, and other services. Within the past couple of years, inflation has been their biggest foe. The Reserve has kept the interest rates up at 5.33%, a two-decade high where they have remained for about a year, in hopes of cooling inflation. Powell says they've seen some positive economic indicators, but not enough to reduce the rate.
My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. You know, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. You know, we just want to see more and gain confidence.
Powell hints there could be a cut coming, possibly as early as September.
If we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table.
In Washington, D.C., Rachel Knapp, WENY News.